Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And boy, we have a very special guest on today. We're going to be unpacking quite a bit of different verticals and topics because this guy has so much experience and expertise in so many things. Let me just share with you a little bit about his background. He has extensive experience in the private equity and VC investments, focusing on high growth technological companies, global investment exposure because of his reach and his network and his Rolodex, which we're going to be diving into, international management, negotiations, consulting, how to structure the actual deal from different stages of these companies and so forth. Focus operation management, achieving more with existing resources, which I always found very interesting, definitely in today's time. Hey, how do we really increase that decrease the churn as well as increase that runway and so forth of our companies? Behavioral economics, decision making process based on behavioral biases, derivatives trading, quantum methods, algorithmic trading. Excuse me, gracious. But we're so excited about having this guy on. That's one of the reasons why we're going to be diving into so many different topics. He's the Chief Investment Officer at Springtide Ventures, the one and only. Please welcome the one and only Boris Chovnik. How are you doing today, Boris?
Hi, great to be here. I'm doing great, and I like your motivation and your energy. So go ahead.
Boris, I am looking forward to this conversation. And one of the things I wanted to get, let's start off a little bit of your background. You have extensive experience in so many different industries and so many different verticals. And now operating and running as a chief investment officer at Springtide. What were you able to leverage in regards to your skills, in regards to your learning experiences from these different things like derivatives trading, algorithmic trading, and so forth, the way you think about that to apply to the way you think about the CIO as a CIO portfolio and underwriting and due diligence, deploying and allocating capital with Springtide?
Okay, I will just start with a little correction. I'm a chief investment analyst, not officer. I mean, like it's in a fund. Typically, like these names, they have very like wide range of definitions. So basically, it's a slightly different role, but because we're a team of four, you get to do everything together, and you basically cover all the decision process, due diligence, everything. So I don't know if I describe well what I do. Let's put it this way. I was involved enough to become right now a general partner in our next fund, and my experience and my functions cover the whole spectrum, basically, of what a typical venture capital fund does. Before joining Springtide and before going forward to our next fund, which we are raising right now, I was doing, as you said, a lot of different things, which altogether, like they bring value and really help me to grow in this industry and to understand it from different perspectives. So, what was your specific question?
No, that makes sense. Well, I'm curious because what's so interesting about Springtide, the way you think about it, you guys are based and you have your HQ in numerous different places. Obviously Tel Aviv, you have an exposure, Prague in Europe, and then also US, Boston. So you have different locations. And with that being said, you have a lot of international deal flow, right? You're working with a lot of different kind of geographical areas and so forth. And you bring a very interesting perspective because you guys are deploying capital in an agnostic way in regards to geography, but also agnostic in regards to, the stage. You can, deploy capital towards Series A and B and up to Series C as well. And the way you guys structure and way you guys think about this is you do have patient capital. You are not definitely with specifically KKCG's capital. You guys don't have to bring back some return for your LPs. And what I found very interesting is you guys, because of that, you're able to think differently. You're able to have a longer time horizon and structure that out. I wanted to ask you on how that by optimizing for that longer time horizon, the way you underwrite and do due diligence with these companies and deploy capital with some of these companies, how does that affect you guys' investment thesis?
Okay, so I will describe my work in Springtide. This is exactly what you just mentioned. Because we have basically an evergreen fund. An evergreen fund, to whoever doesn't know what it means that we always have source of funding and there is no specific date when we have to exit all our investments. So our responsibilities are indeed before our single LP, which is Mr. Karl Komarek, and the whole group. What you mentioned, KKCG, is his group, and we are a wing that invests in venture capital. We do have offices around the world, but we are geography focused on mostly Israel. We use our other geographies to help our portfolio companies to get to expand market reach. So basically, we have a big group in the United States for expansion. We relocated a company over there, and we can do similar things in Europe. We have different collaborations that we have even on a government level that we are working on right now. Because we invest heavily in Israel, and you probably heard from the news what's going on in Israel right now. We're trying to leverage all that to help our portfolio companies, and because we have this structure and because we have this kind of responsibilities which are slightly different from a normal venture capital fund, we can allow ourselves to support our portfolio companies on different stages to really structure deals. And even when, like in a normal venture capital fund, you have to commit a specific way of doing things. Because we have every now and then an investment committee and we talk to our LP, we could show more flexibility and we could actually do more for our companies. So this is really helpful. And this kind of way of thinking led us to make this initiative, which we call CITIF. And basically now we leverage that initiative to support the Israeli companies. Many of the developers, the tech guys that work for those companies, they were drafted to the reserve forces, to the military to protect the country. And because of that, many Israeli startups right now face delays and some difficulties, not just in finance, not just with financing the operations, but also time delays. And we have access here in Europe to good IT human capital experts, and we already leveraged that. We made public posts, got a lot of traction, a lot of interest from people to just outsource themselves to support the Israeli startups, because there is a value here for everybody. Israeli companies, they need the help right now. There is uncertainty, but they could use some help. For the European guys, it's an access to a market which is very, very advanced in terms of technology. Israel is a hub. It's a global hub for innovation. If I'm not mistaken, the R&D expense in Israel is of the highest in the world per capita. The concentration of unicorns that you get from startup investments in Israel is the highest in the world for sure per capita. And because of that, many guys would like to work with our startups, especially because our startups usually are on the frontier of technology, of the future, basically, of everything is what's happening. So this is one thing we're trying to do now because of our, corporate structure that allows us initiatives like that. Another thing that we are trying to do is basically take and relocate some of our teams to Europe, to Prague, so that they can work without thinking about missiles flying over their heads. Those that can. Some of them were called to serve, so they can't.
Well, what I find so interesting about what you're saying, and I've always been a big believer in kind of Israel ecosystem in regards to just not only the talent acquisition there, but also just the amount of resources that are being deployed in there and the tech hub that's going on, specifically in deep tech, AI, ML, cybersecurity, national defense kind of, concepts or business structure. I want to ask you, when you're, definitely as the chief investment analyst, when you're looking at like a Series A, kind of company that's at that stage, maybe in the cybersecurity or AI kind of structure vertical, what is your process outside of, underwriting the team and, that stuff? Looking at the financials, looking at the total addressable market, looking at the proof of concept, things like that that are you're looking at the actual KPIs of the business. What are you guys looking at in regards to underwriting and due diligence where you say, okay, this is a strong bet. I see the company, I see the growth, I see the trajectory, and we want to deploy capital and come in as operators to help facilitate the growth of this company. What are you looking for? Because what I always find interesting in this industry is you could have two VCs or two investors looking at the same company. One decides not to deploy capital, one decides to deploy capital. So it's more of just understanding what you're looking at when you're underwriting these companies, specifically on the KPI financial side of things. What does that look like for you?
Okay. First of all, you have to differentiate between different stages here. The fund that we work as a Springtide has one strategy and one, like it's more or less investing into a broad range of stages from seed, pre-seed to round B, round C. So you would look at different things. And the fund that we're raising right now is looking at seed. So you don't have at seed what you have at round B, for example. So when we are going and we are looking at investments in Israel or for that matter anywhere else in the world, if we look at seed, we first of all check the people because the people are those who are going to make this thing happen. But later on, if you look at growth stages, A, B, C, for example, we do expect to see some traction, some market paying, some revenues, and we will look at revenues. We will look at reoccurring revenues, which is called ARR. Usually, when we invest in SaaS companies, this is a common metric, and we will look at the growth of those revenues. So different stages, different things to look for. Specifically in Israel, and because I am in Israel, I really know about the cultural aspects of some people, and like what's my what's my added value as an Israeli in a team that invests in Israel, right? What I told you right now is basically true about investing in general in venture capital in round C, in seed or in later rounds. But as an Israeli, when I'm looking at people, I know who is coming from where and what kind of societies they are involved. I am aware of the different, for example, we found a very strong correlation between the universities where they studied and the likelihood of getting to a unicorn stage. Very strong correlation. I can share it. It's okay. Basically, I think if you look at all the unicorns that came from Israel, about 70% of the founders were coming from one of the three places. They were either coming from, they were either graduates of Tel Aviv University or the Technion Institute of Technology, or we have a special unit in the intelligence forces in Israel, which is called 8200. This unit is it's known for building experts in cybersecurity, and Israel is very strong in that, and that's one of our verticals. So we know how to source the right human capital at seed in Israel. It's more than just looking at their grades, and it's more than just seeing what kind of speech they give us. There are a lot of there is much you can tell from knowing where they work, where they studied, who their friends are. So that's what we do.
Which makes sense. So, and I appreciate kind of, reiterating the seed and the Series A and Series B and so forth, specifically diving a little bit further into the Series B structure. Okay. Series A and Series B. When you guys are deploying capital, I know you're focused on this first fund, but I want to ask a little bit on this specifically. The reason why is because I understand when you're working with Israel and you want to scale to $1 billion kind of unicorn status company, a lot of times what I've come to understand, depending upon what vertical you're in or what industry, a lot of times you have to get outside of that region because it is small market. You maybe have to kind of hit Europe market, or you have to kind of bridge the gap into the US, for example, and start leveraging, those relationships and so forth. So when you're looking at, underwriting and doing due diligence with these companies, do you also help in an operational sense to bridge that gap, to say, okay, hey, we've been able to dominate the Israel market, and this is specifically at the Series A, Series B. That's where they got tailwind, they got momentum, they got excitement. They're not at a billion unicorn yet, obviously, but they're headed that trajectory. So they're at this stage, and they need to get into those. They need to bridge the gap into other industries, or excuse me, other regions, to be able to obviously maximize their top line. So when you guys are looking at that, is that something that is a key factor in your underwriting due diligence process, specifically at that Series A, Series B stage?
What their willingness to expand?
Well, really, your operational approach, and saying, hey, are they looking to get into these into these other regions? Because then the likeliness, the probability of them getting to unicorn status is so much more high. It's so much higher, instead of just staying locally in that region, for example.
Okay, I got it. I think my answer will be slightly different from what you expected, but trust me, it's gonna be good. It's about why. Okay, I will begin from saying there is a reason why Israel is a hub, and there is a reason why we from Europe invest in Israel, right? Because even though I'm an Israeli and I'm absolutely biased, and for me it's 100% clear why to invest in Israel. Like my guys in my team, at some point, they built a local VC, and they had to figure this out to understand. We want to invest in Israel. Like, okay, Europe is good, Europe is home, but we need to invest in Israel. Okay, so you will understand why this will answer your questions soon enough. So basically, the reason why Israel is such a great ecosystem, and why everyone likes, well, whoever figured this out at some point likes this ecosystem, is because of the Israeli culture and how people operate. I think I read in one of the articles about the Israeli startup ecosystem that Israeli founders, they operate like they jump off a plane, and while falling down, they invent a parachute. Okay, so they're doing this on the fly, and this kind of mindset, this kind of like flexibility and proactive approach, I would say, this is what brings most of the founders from day one, seeing themselves expanding to larger markets outside of Israel. It's by any means their way of seeing the world is like not Israel home. The world is their home. So basically, they have this perception of acquiring all the markets from day one. Okay, so we, as a venture capital fund, we just try to help them, but with whatever we can. But they usually already know what they want. They already have friends in United States and Europe. They already went to United States many times. I would say that Israel, on average, the average Israeli, okay, sees Israel as the 51st state of United States. So it's very natural for Israelis to think of their startup as going to United States as early as, well, day zero. Some of them actually go and register their companies, and they keep the R&D in Israel. So yeah, we don't have to push them there. We don't have to make sure that they have this kind of vision. Israelis already know that they need to scale up. That's why Israel is called a startup nation. Startups are all about scaling up fast.
Which makes sense. Okay, gotcha. And so they are already on that top of mind. They are already looking at, obviously they're going to expand, and it's at that specific stage or certain stages where it's like, okay, hey, how are we going to bridge this? How are we going to, go to market strategy in those specific markets? I appreciate you explaining that. I want to ask you a little bit, when you're looking at, cybersecurity, machine learning, artificial intelligence, that's very, very sexy, but specifically in the SaaS, you guys are deploying it very heavily in the SaaS world. And when you're looking at the SaaS industry, there's a lot of, that's a very big umbrella per se, right? There's a lot of different even verticals within that. That's, HR, and that could be, gaming, that could be all sorts of different SaaS, industries. And I always found that very interesting. But when you're looking at underwriting SaaS specifically, and I know in the new fund, it's a, pre-seed, really. It's kind of seed level, if you will. They haven't achieved go-to-market. They haven't achieved this ARR. However, though, maybe they have achieved some, income and so forth. When you're looking at underwriting, do you like to go more and seeing, okay, hey, is this go-to-market strategy, is this going to be SMB, small businesses, or is this going to be an enterprise kind of, go-to-market strategy? Do you lean one way or the other, where you like to go focus on, B2B enterprise SaaS kind of structure, vertical, or is it more that SMB kind of flow?
Okay, well, normally it's always B2B, so it covers SMBs and a large enterprise. It depends on the market. The SMB can be of different size. SMB in the United States is like large enterprise in Israel. Okay, so the thing is about a large enterprise is the long sales cycle. So when you're a founder and you need to achieve some traction, you need to show your investors that you actually go to market. It is a very dangerous game to try and close like one source of one client, large client, such as enterprise. Most of them, they understand that. First of all, you need diversified streams of income. So you better have, many. And it's difficult enough to close one enterprise. So many of them, they start by working with SMBs, or maybe they work with enterprise, but as design partners. And at some point, they end up also getting enterprise clients after they prove their product worth. So there is no clear preference. I would say we listen to our founders. If they see that their product and their service is better to begin with SMBs, sure.
So in your underwriting due diligence process, that doesn't really carry a lot of weight in regards to the strategy, because like you just mentioned, you're very flexible in that regard. If because again, it's very contextual. I understand, depending upon obviously what vertical it is, what industry that may be, whatever it is. And so it's like, hey, this might be just an SMB play, and then at some point we're going to evolve into enterprise, which I've seen a lot of companies do, and definitely in the fintech space, or obviously go gravitate toward the enterprise. But like you mentioned, the sales cycle is drastically longer. I want to ask you this because I always found this very interesting, definitely in business, right? In business, you really try to solve a problem, a big pain in these kind of in these industries, and that's really where you start seeing the massive growth and scale of these large companies. Definitely, even where they don't have a lot of the resources, but they're able to scale because they're solving such an immense problem. We saw that with Bloomberg. We saw that with MailChimp. We saw that with numerous companies. We just, it's unbelievable the amount of scale. And I'm curious, when you're underwriting or just having these conversations with the founding team, et cetera, how do you think through that process to say, okay, I see the total addressable market, I see the need, but is it just going to, is in addition to the just helping these people out and solving a little bit of pain, or is it actually like really immense pain and solving this issue, and that's the reason why you guys are looking? How do you think through that when you're doing your underwriting of the product itself?
Okay, so this also depends on the stage of your fund focus. If you invest into seed, you look for the outliers. You look for those that will actually disrupt the market, the industry. That's just a simple math. You cannot look for like companies that will just help a little. This has to be revolutionary, and the founders, they need to understand that. They need to know how to pivot every step of the way. And their product is usually the product and the service that they offer is there is nothing like that in the market. I mean, if it works, if they receive positive traction, it's a unicorn. Boom, that's it. So if you invest in later stages, you expect different things from your investments. Maybe you will be satisfied with less excess, like on return on your investment. When you invest private equity, it's absolutely different story. So specifically with early stage investments in venture capital, it's a game of outliers. So it needs to disrupt.
And that's the way you think about that. But how does your team, and I understand, like definitely at the seed level, you're not able to really maybe underwrite that properly, but the Series A and Series B, you can get kind of a heartbeat a little bit and saying, is this disrupting? Because you can start seeing, so what diving down a little bit deeper, how do you identify, in a company when you're underwriting, hey, this is disrupting this industry drastically, and there's going to be a huge massive momentum, tailwind, excitement. And then also where there's another company where it's like, okay, they got momentum and they got some good ARR, everything looks good, all the green flags. However, though, this may not be a billion-dollar company. This may not be a unicorn because it's not really solving that main problem for these and the pain of these clients. But this one over here, this one is, and it's going to be massive scale and a beautiful return. I just want to dive into that a little bit deeper because the way you think about that, it's the difference between deploying capital or not. It's the difference between a massive, beautiful return and not.
Well, as I told you before, if you invest in seed, you will definitely go only for the billion-dollar companies in potential, even if they're very far from it, even if it's unclear, even if the risk is super high. If you invest late stages, yeah, you can say, okay, so it's not a unicorn, but I will make my money and I will exit through an M&A or whatever, especially in private equity deals. Typically, venture capital is all about outliers. Like, to be more specific, we look at a company, we look at the market size. If we see that they're aiming to a multi-billion-dollar market size, and we ask ourselves, okay, this product is so promising that even if they capture only 1% of that market, even not becoming, like an industry leader, but they just, conquer some niche, some 1%, not 20, will they give us enough return to, compensate for all the other losses in the portfolio? So this kind of math we have through our due diligence process, through our, like how we analyze companies.
Okay, which makes sense. That makes perfect sense. I want to dive into this also. When I do due diligence and underwriting of these companies, what I've come to realize is that maybe I have an investment thesis per se, but it might be 6 or 7 points depending upon obviously the vertical as well as the industry and so forth. And what I've come to realize, and again, you've been in this industry a lot longer than I have, so that's the reason why I'm asking you this question. And I've been only about 2.5 years. And what I've come to realize very quickly is that maybe this company doesn't hit every single one of my checkpoints that align with my investment thesis. However, though, it might hit 80%. And so with that being said, I have to take a calculated risk and say, okay, well, which items am I weighing more versus less, right? And so just like you mentioned as well, it's like, hey, you look at the total addressable market. You also look at, hey, are these companies bridging the gap over to these other regions and these other markets and so forth? So a lot of that is you carry some weight, but also not too much weight, right? You're also looking, hey, do we have some good tailwind, proof of concept, et cetera? I want to ask you because again, this is nothing's ever easy. All companies are drastically different. They maybe had a good year one year and maybe not so good the next year. And I'm specifically talking about Series A and Series B because that's where you got a lot of financials and KPIs like I mentioned that you can actually underwrite and so forth. So when you see some of this where, okay, we've got this 15-point checklist, it has to align with that, but maybe it doesn't. Maybe it's only 10 or 15, 10 or 11 that actually check it off, but there's other, checkpoints that's like, how much are we going to weigh each item? When you look at that, how do you identify, okay, are you going to deploy capital or are you thinking more strategically and saying, hey, maybe they didn't hit every single one of our checkpoints. That's okay. We're going to deploy a smaller check for now, and then maybe we'll do a roundup later on, another round on check, because hey, once they establish these certain KPIs, then we feel more comfortable and again mitigating that risk. I'm just curious how you guys approach that. Definitely when you're like, hey, we see the trajectory, we see it, they've hit almost 80% of our underwriting process or due diligence process, but there's just that little extra bit that we're just kind of not sure on. How do you approach that?
Well, some things we weigh them more, we give them more weight than other things, and we talk to the team. If we see that the team is coachable, okay, we call it coachable. Basically, if they listen to the reason, if we see a reason, if we look at them, analyzing them, and we understand why they did not, like achieve what they wanted to achieve, what they were telling the world they will achieve, and we see the reason, we can coach them, we can help them get through this and maybe change something. Then we talk to them. If they indeed listen, if they're coachable, we can work with such people, with such founders. But if they have a mind of their own and their way of, I mean, even a slight deviation from what we expect to see would be enough reason to not continue.
Can you give me an example of something happening? Not in regards to like the team, but I understand. I love that concept where you're saying, hey, you got to dive deeper into the context of why they didn't hit their KPIs in maybe a certain year, or why they don't have year over year, XYZ growth or whatever, right? There's certain things you have to build context around it. Well, what was the reason behind it? What are your margins? Why are your margins being eaten up? What's your burn? Why, things like that. That's, you have to build a little bit more context and understanding it. So I understand. I love what you said. You weigh that and just having a conversation with the team and the founder and saying, hey, give me more context around this specific metric and the reason why it wasn't being hit XYZ. Can you give me an example in regards to maybe, recent underwriting due diligence of a company? You don't have to mention the name or the founder, et cetera, but I'd love for you to just kind of share with your process when, an example of that.
Example. Yeah, I could probably give you an example, but
well, while you're thinking, Boris, I was thinking of an example for my own self. I remember distinctively just recently, I was underwriting a really great company. They were doing about $8 million top line. They had some good margins. Everything was really looking good. They were in the pharmaceutical industry, but they were after FDA approval. So that mitigated the risk in regards to my investment thesis. But one of the things that concerned me that I waited quite a bit is who was on the cap table. And so, the guy, that was helping me underwrite this process, he shared with me who's on the cap table. And one of the co-founders that owned about 26% of the company still, he was not part of the company anymore. And that was a concern for me because I'm thinking, okay, first of all, that's a pretty decent sized chunk of ownership, and you're not actively involved. And so I wanted to get more context exactly what happened. Did they have a falling out? Did they just decide to go a different trajectory? What exactly happened? And can we get this individual off the cap table? Because he was in a situation where he had still voting rights and he had a lot of power because he owned 26% of the company. And so I thought, well, that's a factor. Whenever I deploy capital, that's a factor that I can't control. And whenever there's factors or variables that I can't control, that's a red flag for me, or at least a yellow flag. And so as I started doing due diligence, underwriting a little bit further into it, everything else was fine. The KPIs, the metrics, the year over year growth, all that fun stuff. But there's one thing that just was not really sitting well with me. And so then I decided not to deploy capital, mainly because after I built some more context in the situation, then I was able to identify, okay, well, they actually had a falling out a little bit. It's not the best relationship. They obviously smoothed it over because of the business overall. But that was just, as an investor, that was a variable that I did not want to play with, even though everything else looked fine. And so I just want to, share that example because I see this all the time where maybe it might be that one or two or three things that just don't feel very comfortable, specifically at that Series A and Series B level, where it's like, okay, you got momentum, you got tailwind, you got excitement. And I've seen this also with, year over year growth. Sometimes people want this year over year growth of, really, really massive, beautiful trajectory, et cetera. But obviously COVID, things like that, whatever, market, industry, wars, whatever, kind of can be explosive in regards to your bottom line as well as your top line growth. And so you have to build context around it. And so that's what I found interesting about it. Is like you just have to understand. So I'd love for you to now maybe give you some time to think about maybe an example for yourself, Boris.
Okay, just with regard to what you just said, and with the experience that we had with our portfolio companies in other cases that we are aware of the situation there, This is very common, and I would divide it into two. Like you have external reasons for a failure, okay, and sometimes it's hard to predict what's going to happen. Trends in the markets change. You have all kind of situation. You have black swan events like what we had with COVID, uh, with quantitative easing later, and with rising interest rates. So like some things you can predict to some extent, but the founders, they usually focus on what they're doing, and like they could miss some of the major trends shifting in the market. So this is one thing, right? External things that could lead to a failure. You were building a product, market conditions changed, your product is no longer well required. So what you do in those cases? The second case is internal, and those are the red flags that you saw in the cap table. You saw somebody who was you were not clear, right, about what are they doing, what they want, and what kind of influence they have, right? Um, this is one case. We see a lot companies that reach the growth stages, and the CEO, which was great in building a team, the initial team, and he was great in getting first deals, first POCs. He's not really good at sales later. When you need to really pivot and you have to scale up, you have to really be good in this process, right? You have to shift your way of thinking instead of micromanaging all the operations and R&D and everything. You have to become a really good salesperson. So many of them face this difficulty to go from early stage to growth stage. So yeah, in those cases you could intervene, and if they are flexible and coachable and understand their weak points, weaknesses. Sorry, I mean, like you can help them and find somebody to for this job to do that. Another thing that we see internal as a red flag is when we look at the cap table and we see a lot of low ownership at the company on the founder side. Basically diluted to an extent that they no longer hold more than like 10-20% of the company. But this is something which also a red flag, because it hurts the motivation they have. It can be also the other way around. If they have everything and they were bootstrapping all this time, maybe they don't know how to share, how to let go, how to delegate. So like there are a lot of internal threats as well as external. But regardless of what kind of reasons you have, external or internal, what is the most important thing in the end is, are they flexible enough to adjust and adapt? Are they coachable again? So if the market changed because of external reasons and they understand, they will make the necessary adjustments to their service and they will meet the new needs in the market, right? They will explain it to their clients. We can see, you were talking about metrics before, right? We expected to achieve this kind of growth. We did not achieve that. Why? And if we see a lot of high churn rate, clients are leaving, something is wrong, right? So we investigate. We don't say, okay, your service is no longer needed in the market. We have a cut in the company. We don't want it to go bankrupt, right? And if there is something we can do, whether it's advice or an introduction or getting additional funding so they can make the necessary changes, we try to do that. But it all comes down to the team.
It does 100%. And that leads us right into a good question in regards to your new fund, where you mainly focus on a lot of seed investing and specifically in these industries we've been talking about. So I want to unpack this a little bit. When you're having these conversations with these founders and just having these contextual conversations, you're underwriting it, you're looking at this stuff. This is at the seed stage. But one of the things I always find interesting is in this cybersecurity SaaS world, it is definitely in that ecosystem. There's a lot of competition in regards to a lot of investors looking for those kind of deal flows, right? And there's a lot of opportunities, don't get me wrong. However, though, sometimes what I've noticed with a lot of the founders I've talked with is that they can be very selective in regards to what investors get on their cap table or that play a part in their kind of company growth. And it's not just a matter of, hey, you can write a check, et cetera. They're looking for, hey, who are strategic partners, strategic investors that can come alongside, and whether they can open up their Rolodex, whether they can bridge the gap into other different enterprise clients, opening up the doors, et cetera, et cetera. Right? There's so many different ways of thinking about it, or maybe even marketing advice, et cetera. R&D, whatever it may be. How do you guys look at that in regards to making sure when you are, competing against other investors for certain companies? Definitely in this ecosystem, right, over in Israel, where there's some really hot, sexy, beautiful stuff that's going on. Um, you do need to bring value as an investor, as an active investor. And I know you guys do more of an operational approach. I'd love for you to just talk to us a little bit about that conversation with the founder and saying, hey, this is the kind of the immense value that we bring as an active investor as well as a fund.
Absolutely. Well, in venture capital, your network is your everything, and you can achieve so much with the right people in your network, and that's exactly what we are doing. Now, when we look to invest into Israeli companies, first of all, we know our ship. We have very good understanding in technology. Some of our partners, like one partner is actually 30 years from IT, used to be a CTO. Another partner in the United States, she is a very senior executive. She worked for many of the Fortune 500 companies as a CTO, on all the executive. And we created over the years, we have built over the years a large advisory board. So basically, when we speak to the founders, first of all, we have the same language with them, because even if they speak to us in tech language, not only we understand, but we also, and by this time, we already have enough experience with similar companies, and we brought some of those companies to an exit point, and we know the right people to achieve that and to repeat this success. So founders like that. More than that, as Springtide now, I can tell you that we are part of a large corporate group. So many of the companies in this group are actually design partners or potential clients for our portfolio companies. This is another thing that founders like a lot. So we provide enough value for them to like us. They're less picky at seed, but soon enough they realize that it's important to choose your investors wisely. So starting round A, they do look for the right partners. The savvy ones, they look from day one for the right partners. And we are lucky enough to work with very smart founders, and they let us invest in them as early as pre-seed. So this is tells you something about trust. And we also have a very good relationship with other venture capital funds in our ecosystem. So we share deals. We have people that are happy to co-invest with us.
What's your perspective? I was talking to an investor friend of mine the other day, and we were talking about, and he was sharing with me this arbitrage, the way he thinks about the markets. So when everybody was deploying capital in AI and ML recently, he actually tried to pivot and look at other different industries that are not getting a lot of capital. I mean, the reason why he says that is because when you see those industries or those verticals that don't and that aren't, and so like for example, he was deploying a lot of capital in manufacturing, which I found very interesting. I thought, okay, why? And I want to understand that a little bit more because obviously the returns and the multiples on the back end and for exits may not be the best. But he's like, no. The way I think about it is because when you find these verticals or these kind of arbitrage opportunities where these markets where they're not getting a lot of capital, a lot of times you can actually get a credible amount of alpha, right? You can get a lot of bang for your buck, if you will. Do you think the same way? Because obviously I know cybersecurity, national defense, AI, ML, we've been talking mainly on that and SaaS even. Israel is a beautiful hub of that, mainly because of what you just mentioned as well, because of just the talent, because of the amazing resources and so forth. But sometimes you want to make sure that you don't get overpicked deals, right? And so I was just curious the way you think about it. Are you looking at, okay, even within the SaaS world, okay, sure, a lot of SaaS tend to go more tech, but maybe you're looking at SaaS, but also in different specific verticals, supply chain, whatever it may be, and say, hey, there's these specific micro niches, if you will, that aren't getting a lot of capital. And that's what we want to start looking at because we could see a lot of alpha. I just want to ask you on that specific subject because I just found that thought process, that mindset, very interesting to me.
Okay, well, opportunities, they can be in different places, right? But the thing is about industries, about verticals that attract a lot of attention, and you would say, okay, everybody invests there, so you're unlikely to get alpha there, right? Above market, above average returns, right? So this doesn't work if you really understand the vertical, if you really understand the tech. So you can easily say, okay, even though like everyone is doing AI, right? But even though everyone is doing that, it doesn't mean that everyone can tell which company is actually not in the red ocean, which one is actually operating with with such a huge advantage ahead of everyone that it's not the red ocean for this company, for this team, right? So basically, we are not afraid to go where there is competition. We go and we look for those that have the highest chances of disrupting that space. So for us, it's a no-brainer. We don't really need to go to some places where no one else is going. Usually there is a reason why no one else is going there, because even though you can get some opportunities there and maybe some alpha, uh, well, usually those are not disruptive places, right? And venture capital is all about disruption. You're looking for hundreds of X's. And that for that reason, we invest in what we understand. And we have a process. And we go to those, what seems to be red ocean, and find the winners. That's as simple as that.
That makes sense. That makes sense because to give a little bit more context around the investor I was talking with, he was talking about kind of that private equity mid cap, mental model, if you will. So in that context, it does make sense. But I see where you're coming from. You're looking for disruptors, and you're looking for where's the money being allocated in these specific industries. I appreciate you just kind of highlighting on that because I just found that mental model, if you will, very intriguing to me in regards to the way he thought about that. I was like, I don't know if you're right on that, if there's correlation. When you mentioned something earlier on, I want to double click on it and I want to loop back around on it. You mentioned there you found there's correlation between obviously where they have graduated in regards to the university as well as where they're coming from to the unicorn status of these companies and in regards to the founder. What other correlations have you found that are direct correlation to, hey, are there other certain patterns that you've identified, whether it's character, personality, or whether it's from their own education or their background, et cetera, that you've identified and says, hey, we see that there is a direct correlation behind this?
Okay. So what I mentioned about universities and the secret intelligence unit is something quantitative. I can verify this by using statistics. The other things that we noticed are qualitative. It's based on our experience, on our observations. I don't have enough definite proof to back my words, but I would say that one thing I already mentioned, them being coachable, them being flexible enough to adjust and adapt when the circumstances change. So this is very important. And another thing that we like to see is people that complement each other. Basically, one is, I don't know, a tech guy, and the other guy should be good, like social, with people's skills, like know how to sell, how to pitch, how to be concise, how to deliver the value points to the potential it is a partner or a client. So we like to see complementing teams and flexible enough people. And if they graduated from Technion Tel Aviv University or 8200 unit, great, even better.
That makes sense. Okay. I want to ask you with investors on the cap table. I have talked to some family offices where, definitely depending upon if they're international or so, they like to have a lead investor, right? Or maybe even, a 600-pound gorilla, right? The big wigs, Andreessen Horowitz, things like that of that nature, GigaFund, et cetera, that deploy capital. And when people see their credible fund deploying capital, they're like, okay, I'm deploying capital alongside, right? Co-invest kind of strategy. Are you the same way when in regards to the way you think about it, or are you like, hey, I really don't care who else is investing because we see this opportunity, we see what's going on, we've done our own due diligence, we can make our own decisions, not based upon what's sexy, what's not, what's trendy, but we can come over here as a lead investor as well. I want to get your perspective on that because I do understand that everybody's different, and some people they do weigh heavy on okay, you see these other larger funds that can come in and deploy capital and they carry some weight. It does, it's like almost like Berkshire Hathaway buying a company. It's like, okay, why do they buy that company? It must be very profitable, right? Or whatever. They buy a stock or something, right? On the New York Stock Exchange. Okay, well, why are they buying that, right? It just carries more weight in the market, in the industry. So I'm curious if you think the same way or if it's irrelevant for you and your team.
Yeah, well, okay. First thing first, we did lead and not lead. I mean, this was not a problem in Springtide. But in the next fund, because it's a seed fund, it's at later stages, it's really hard to lead. We need to come up with a lot of money to put. For us, it's very important who is co-investing with us. Of course, when we are in in pre-seed, like we can easily cover all the whole round, and we are fine with that. But later on, we do want to see strong co-investment partners that could leverage their network and bring a lot of value. And we have funds that we like to co-invest with. So we glad to share those kind of investment opportunities. And if they lead, sure. I mean, depends how much money they put. Now we speak, now these days we warehouse investments for our next fund. So even before we closed it, now during the raising process, we do talk to founders. We do invest our own money, small checks, but we do plan to lend these investments into the next fund. And because we don't have a lot of negotiation power with the founders right now, we have these discussions. Sometimes they say, well, I prefer less investors in a round, for example. And some of them really thought this way until they, spoke to us. And we explained that with every investor that they bring the investors' network. And that grows value exponentially. So my advice to pretty much every founder out there, if you can choose between having one lead investor that closes your round or having several to support you, I would recommend having several because if they're active, if they're actually willing to help you in difficult times, you will get so much more value from more funds because the game is to have large networks. Every venture capitalist knows that your strength is in your network. So normally we all have very good networks, and it would be unwise to just say, no, I want one investor in this round. Like, why?
Yeah, that's true. Definitely, today's world is all about building relationships and just knowing, the right people, and they were able to open up the right door. I remember I was talking to a private equity company, and they take it's actually remarkable the Rolodex and the network that they have, and they come over here and buy a small mid cap company, And then all of a sudden they open up doors because they know all these enterprise clients on the back end. And so they're very, very dialed in. They know exactly what kind of companies that they're able to open up the right doors. And then boom, all of a sudden they increase the top line revenue just by opening it up and having the Rolodex that they have. And it's incredible to see that. Boris, I really appreciate you being on here, just talking about the way you were thinking about it. I know we kind of gravitated on a lot of different stages, a lot of different industries, but the way you're able to unpack it, it tells to me that no matter what region you're in investing, whether it's US or Israel or Europe area, or even whichever industry or vertical you guys are in, or what path you're in, the way you're able to look at it is through a methodical approach in regards to due diligence and underwriting, you and your team. And it's just cool to have someone like yourself, a chief investment analyst, that are able to unpack that at a more micro level, depending upon obviously each stage, vertical. There's a lot that goes into it, and the way you look at it, building a very contextualized kind of mental model, if you will. Boris, for those that want to reach out to you, maybe want to learn a little bit more about what's going on specifically with your fund, or they just want to connect with you to learn a little bit more about the exciting ecosystem and the amazing tech hub that's going on in Israel, how do they reach out to you and be part of what you got
The
going
best
on?
way to reach out to me is through LinkedIn. Just this is the fastest response they would get. I mean, like, they can write emails, they can go to our website, but the fastest way to get a response is to just text me on LinkedIn.
Awesome. And I'll put his LinkedIn account down there in the description. And also I'll put Springtide website also, just so that people can get a glimpse of it as well. They get a whole bunch of good content out there and the way they think about investment. But obviously we unpacked a lot of that today. Boris, I mean, I really appreciate you being on here. Guys, that is my friend, the chief investment analyst at Springtide Ventures, the one and only Boris Chovnik. Guys, that is Journey with Christian David's podcast. Until next time, be uncommon if you can. Boris.